Every time I hear an introduction like that, I really have to smack myself in the head and say, why do you go from one really bad job to another really bad job? There's no learning going on here. I always like when people also say some difficult choices. I think since I've been at the budget division, I don't think there's been any easy choices, and certainly none that we take lightly or the governor takes lightly. And the other bad thing about this position, unlike the tax position, is this is a much more Albany-centric position, so we know how, it is a kind of small town, Albany, so I now run through parking lots and things like that to try to avoid contact with people. So anyway, all kidding aside, we've been in very, very difficult fiscal times over the past 3 years. I think people forget what makes this kind of cycle unique is that so far it's not a cycle. I mean, typically we go into a recession, we stay in a recession for a period of time. New York has tended over the years to stay in recession longer than the nation. But eventually we come out of it on the other side, and usually with pretty robust growth. And that robust growth has covered a lot of sins in New York, fiscal sins. And what's happened now is we're entering into really our third and fourth years of really difficult fiscal times where the economy is not bailing us out. And so I'll talk a little bit about that in the slides that follow. I should point out this, though it's dated November 18th, is a dated presentation, but as we go through it, I'll try to update you on where we are now. And I was hopeful a few weeks ago that I could say how much better things had gotten, but that's not true. So let's start, and then maybe we can leave some time for people to ask questions. But again, this is not a theme that's going to be new to anyone, that's here today, given where our situation is and where we're headed. We passed the budget pretty late this year as we struggled with the legislature to try to close a $9.2 billion gap, which we believe we did in the budget. Now we would say, again, this is a little bit of a dated slide, that a gap has opened up in the current fiscal year 10-11. We've identified in the mid-year report that we put out a few weeks ago that we think that gap is about $315 million. So that would add to the 9.2. As you all know, the governor is having the legislature come back on the 29th, I think is the date, though I don't know if that's formally been settled or not. And I think we would propose legislation at that session to eliminate the remaining gap. I think at our quick start meeting last week with the legislature, while people didn't specifically talk about gaps, I think the other thing is that there was a kind of uniform recognition across legislative staffs and with the controller that our fiscal situation, follows along the parameters that I'm going to talk about today, none of which are good. We did feel that we achieved a lot of recurring savings in this budget. Was the budget perfect? No, budgets are never perfect from the executive's point of view. The executive usually would like to cut deeper and do it in a recurring basis, but we think that this budget was done in a pretty effective way and has a lot of recurring spending cuts. We did reduce an enormous out-year gap to a slightly more manageable, enormous out-year gap. We managed risk by the way and I think this was a big get in the budget this year that hasn't gotten a lot of publicity, was the legislature gave us the authority because there was some question about how much money we were going to get from the feds in terms of Medicaid. FMAP is kind of how much the feds pay for every dollar of Medicaid expenditure in the state. The normal formula is that the state gets 50 cents from the feds, and as part of the stimulus, For the past 2.5 years, we've been getting 62 cents roughly for every dollar. So the feds have been helping us cover our Medicaid costs. That was supposed to sunset. We had assumed that it would be extended for 6 months in the budget because the president had put that in his budget. It became clear it was not going to be extended at the full amount we had expected. We asked the legislature to give us the ability, if it was not extended or extended at the full amount, to do across-the-board cuts to cover any gap that created, and the legislature gave us the authority to do that, which we think was important and hopefully precedential in the sense that, we think it's important that the executive has some flexibility in times like this to do kind of across-the-board cuts in a fair way that the legislature has signed on to through legislative activity, not arbitrarily. Again, we tried to keep annual spending pretty low. We're trying to reduce our planned bond issuing to try to keep our below capital caps that are in statute. And we did preserve our rainy day fund. And we didn't borrow for operating expenses, and we didn't borrow to cover any of our $9.2 billion deficit. So how did we close the gap? And the reason why spending time like this, I think, gives you a sense of where we're going to have to go in the future. How did we close our gap? We closed it largely with spending reductions, about 69%. You can see the extension of FMAP. We had expected to get over $1 billion. We ended up getting $804 million from the Fed. There were some non-recurring actions. The colloquialism is one-shots, but I don't think $660 million by historical standards is a lot of non-recurring actions with the budget. Tax audits and recoveries, about $371 million. That means we added some tax staff to be more aggressive in collecting money already owed the state by taxpayers, and also the Medicaid Inspector General to go out and to continue to increase our recoveries on Medicaid fraud and abuse. And revenue actions of about $1 billion, which included, eliminating charitable deductions for, millionaires who currently get to deduct 50% of their charitable deduction. We eliminated that. Ability for New York State, which we did not think was a terrible thing, and a few other revenue-raising actions, which totaled a relatively small part of the total. And this, I'm not going to spend a lot of time on this, kind of shows what happened to spending once we did all of those things. And again, one of the adjustments we make, really the only real adjustment we make, is we delayed a school aid payment in March of last year of this year to kind of help us manage our cash flow. I guess that's an interesting way of saying we were running out of money. And so we delayed a school aid payment that was normally paid in March, but not statutorily due until June. So our view was that we could make that payment in June, and that's what we chose to do. School districts did not, and the union didn't take the same view, and so we're being sued on that point, but I think we feel pretty confident that that was a statutory action we could take. So we adjust for the fact that we had planned to spend that money in March, but we spent it in June, so we kind of switched that back to adjust the growth rates, and this kind of gets you to the fact that we don't think state operating fund spending, given this budget, is increasing that much. Now, something has changed since this went into effect, and that is, and I don't really have a chart on it, but that is another thing that has changed, is our Medicaid spending has been increasing at a faster rate than we had expected when we did the enacted budget. We had anticipated that the increases in Medicaid caseload would have leveled off by now, going out into the future, and that has not happened. And that's another outcome of the economy that we're in right now. At the beginning of this recession, the Medicaid caseload in New York State was about 4.2 million. We think that by the end of the current fiscal year, the caseload will be up now to about 4.9 million. So over, again, a 2.5 to 3 year period, we've had an increase in caseload of about 700,000. That's a significant impact. Most of those are, you know, children and adults, working adults who kind of have lost their job or who have fallen below the threshold or are now working for an employer who doesn't necessarily provide insurance, and so the Medicaid caseload has really kind of surged. And so, again, an expense that we thought would have plateaued, which continues to increase. So that's one of the reasons why that we have a gap associated with the current budget year. That's one of the areas where expenses continue to increase. But this is an interesting chart because this is something that's not really going away soon, which is, you know, we have some sources of growth that I think are really fixed costs in the short run. I think sometimes it gets misunderstood when we say fixed costs that we mean we can never change these things. That's not what we're saying. We're saying in the relative short run, these are relatively fixed costs. And they are debt service, and you can see how much debt service is projected or has increased in the current last year and into the current year. You can see fringe benefit increases and how much those have gone up. And fringe benefits is basically health insurance for state employees and retirees, and also pension costs. And so that 14%, by the way, also assumes the controller's kind of smoothing program, which was put in place for the 10-11 budget year and extending out, or else that fringe benefit line of 14% growth would be even higher. So again, we have a lot of debt service costs, which are borrowings from the past where we're paying the interest cost on those now. And a lot of that, by the way, that increased debt service cost really is a sin of the past, where we took a transportation plan we couldn't fund 6 years ago, and we basically restructured the debt, and those debt service costs are now hitting us now. And so a big part of that debt service increase is that impact of a bad decision that was made, 5, 6, 7 years ago. And the fringe benefit increases, especially on the pension side, has a lot to do with the fact that the value, of the pension fund has gone down as the, value of securities went down. Also, the fact that interest rates are close to zero doesn't help that part of the controller's portfolio that's invested in government obligations. So you have basically a depressed value to the pension fund, which means the employer contribution has to increase. And one thing, I will tout New York a little bit, we make our pension contribution. Yes, we may amortize, we may follow this plan over time, but we've never not made a pension contribution payment. Some folks in adjoining states don't make a pension contribution and get credit for it. That seems to me a little crazy, but we have been pretty good about making our pension payments on time and in a timely way. So again, we have important fixed costs. If you look at personal service costs, if you look at non-personal service costs, and even if you look at local assistance, which is where we spend the bulk of our money, we've tried to keep spending at relatively flat or negative. This is a dated chart. At the time of the enacted budget, we assumed an $8.2 billion out-year gap that the governor-elect would have to handle, but in our mid-year report, we increased that number, as most of you know, to $9 billion. So the $315 million annualizes, in our view, to a little over $800 million, and so we have at least a $9 billion gap The legislative fiscal committees have already said with their revenue estimates that they think that the gap could even be higher than that. I guess if you ask, it's hard to figure out how to interpret some of these reports, but maybe as high as $1 billion. And so you could be talking a gap that the incoming governor will have to solve in the range of $9 to $10 billion. This is after, and this is the point I was trying to make before, this is after 2 years of substantial spending reduction. Again, that's a kind of where you sit discussion about whether you think those were substantial spending reductions or not. Those of you that work for state agencies probably think they were significant spending reductions. Those of you who are in the outside world probably think they weren't big enough. But we also did do a surcharge on the income tax 2 years ago. We did the revenue actions we talked about before. So over the past 3 years, we have done spending reduction, we have done tax increases, we have done all the normal things that state governments do when they confront bad fiscal times, and we still have a huge fiscal problem in the out year, largely because of bullet free, which is $5.1 billion in federal aid goes away in 11-12. That's mainly money that went to Medicaid, as we talked. That's 63 cents of every dollar we spend instead of the 50 cents. And that's important because we believe most of that caseload we would have had to have picked up anyway. It's not an area where, oh, well, we could have just cut that. We might have had to have cut in other areas, but we probably would have had to spend on that caseload, since that's, you know, an entitlement, that the feds really put pretty strict regulations on eliminating eligibility. So we think that that expense is something that comes back to us next year. Those caseload people aren't going away. So we have to figure out a way to spend on that. So you probably have to cut in other places or other parts of the Medicaid program. And the same is true in school aid, but to a smaller degree, where we were getting significant ARA resources that were supporting school aid spending, or the school aid reductions that we would have had to have taken over the past 2 years, and they were significant, would have had to have been larger. So that $5 billion goes away. We also, the income tax surcharge sunsets, and so in 2011, we lose, I think, $1 billion roughly from the surcharge expiring. So there's a significant amount of resource that's been propping up the budget over the past 2 years that's going away. So anyone who's thinking that, you know, we've entered an era where, you know, the budget choices have gotten easier is really, you know, just not looking at the numbers. The budget choices are going to be very, very difficult this year. Well, this is relevant because some of these things have happened since we did this chart. You know, economic growth has recovered. The economy has stabilized. You know, our employment situation in New York, and this is hard to believe given the other things we've been talking about, we've done better than the nation in terms of both employment losses, the unemployment rate, base employment. We've actually have a situation in New York where we haven't been, like in typical recessions, lost, you know, proportionately, you know, 2 times as many jobs as, you know, similar states. That's not been true. Our economy has actually, in terms of employment, we've lost 250,000 jobs. That's a horrible thing, but in the early 90s, we lost over 500,000 jobs during the recession. So in terms of job loss, it hasn't been devastating. It's been terrible. What we've really lost is an enormous amount of income. And so we lost a lot of income for several reasons, and we'll get into that. And income's what we tax, and that's how we, you know, the source for a big chunk of how we support spending. And so yes, the economy slowed down, but it really happened in other places too. And by the way, people might have still been working, but they stopped buying things. And so this was the first time in history I can remember, and there's some tax department people here who know better than I do. But we had last year, 9-10 rolling into 10-11, 7, 8, and 10% month over year ago month declines in sales tax. That's unprecedented. It really is. Typically, sales tax is less volatile over the cycle than the income tax because a lot of taxable commodities are kind of fairly stable. Yes, it goes down, growth may go to zero, but we usually don't see big declines in the base. And we saw very big declines in the base. So has that stabilized? Yes. Are we growing again? Yes, but we're growing off of that lower base. And all that income that we lost that we were taxing, has it stabilized? Yes, but it's growing off that much lower base. So as a result, it's going to take us, we think, a long time to get back to where we were. And that first bullet kind of says that, you know, it's the 7.2% decline in wages, you know, on a year-over-year basis. You know, the wage bill in New York, somewhere, I don't know, $550 billion, something like that. When you lose 7% of that, you're losing a lot of income tax. And so I think we continue to see that we believe that will turn around. In fact, we believe that wage growth will grow at about 5%. We've probably ticked that down a little bit now, given results through September and October. But we're still expecting growth. That's the other thing to remember about the risk profile of the state right now. We're still expecting the economy now to continue to grow. That's built into our estimates. So it's not like we can say, oh, you know, if the economy grows by a few percent, it'll bail them out of this fiscal issue. We're already assuming that that's true. We believe that's a reasonable assumption. And we believe our assumptions are relatively conservative. But we do believe the economy's bottomed out and it's growing, but it's growing off a much smaller base. So look at something that everyone talks about. And I am the one and will continue to be the defender of Wall Street. I like bonuses because we tax them. So you can see back in 2007 and 2008, this is kind of budget divisions, kind of estimates of, you know, that was the wage bill. That $500 billion I was talking about, and this was kind of that, about $52 billion was bonuses, typically paid out between January and March of a year as the financial service sector settles up their compensation with their employees. So a lot of that comes at the end of the fiscal year, which is another risk that we face every year. So what happened? Well, that went down to $33 billion. So you lost, you know, $20 billion of taxable income. That's not a good thing. You can see that wages themselves dropped, and that's that big drop we talked about in here, but that the bonus drop accounted for a big chunk of that. And you can see going out, we have growth back in bonuses, but we don't recover the base over our entire forecast period. So we believe we're being relatively conservative, but, you know, we're not assuming no growth. And then you can see we have modest growth in wages over the forecast period. So again, you know, the big story here is the amount of income that we lost that was subject to tax, and that it'll take us a long time, even under, you know, fairly conservative assumptions, but still that there's growth, it'll take us a long time to get back to even to where we were. The same is true with capital gains, maybe even more extreme. We think that in 2007 that, you know, we had capital gains realizations of $118 billion that showed up on New York State tax returns. Those are people that have made money in the stock market. Those are people who sold a house at a significant gain. Those are people, small businesses and large businesses, who sold assets and reported that as income on their tax returns. And that went from $118 billion down to $55 billion. So there's a huge chunk of income that we were taxing that just went away. Now again, a lot here, this is an interesting question. I think I saw this even mentioned in one of EJ's articles the other day. A question really comes to, this is where federal and state policy kind of come together in a very indirect way. If the Bush tax cuts were not extended, which was a reasonable assumption based on, again, the president's proposal, then you would expect that at least some activity of selling stock to take advantage of lower rates by wealthy individuals would have taken place in 2010. As people tried to get the benefit of the lower rate, they'd recognize the income in a year when rates were lower. If that does not happen, which now it looks increasingly like that won't happen, then you would have to take any gain from that and kind of spread it back out over the year. If you had a temporary extension for 2 years, say, then you would expect people might wait 2 years before, or even longer, before they realized those gains. So that has a question of how much income you shift in and out of a year, which will have an impact on our cash. So that's another kind of risk to the forecast going forward. So in reality, it's on the basis of billions of dollars, a relatively small risk. Here's, you can see the impact of the surcharge and what happens, because we have a 3-year surcharge in place. What happens when the surcharge goes away? And this gets into why it's tough to work in the budget division or the tax department, is that there's a difference between when the liability is due and when the cash comes into the state. Because the liabilities due on a tax year are calculated on a tax year basis, but you know that the fiscal year that shows up in could be different because we withhold from people's checks on an ongoing basis. They make estimated payments with us, and then they settle up with us on April 15th. So you're crossing potentially 3 fiscal years. Cash payments cross 3 fiscal years for 1 tax year. And so you get this kind of cash impact on the bottom and kind of liability here. And this is just kind of on a liability basis. And you can see we did a 3-year surcharge back after 9/11 in 2003, and that kind of phased out. And we expect that this will phase out. Now on a cash basis, the 11-12 impact of the surcharge going away, we think is only about $1 billion. Is that it? I thought I had more. Again, I guess the main points I would make, we have a $9 to $10 billion budget that the next governor is going to have to close. That is based on, I think, reasonable assumptions, but there are still significant risks out there. If the economy should not improve as much as we think it would improve, that gap is only going to widen. If our Medicaid-based caseload spending and our public assistance caseload continues to increase, then that is going to put more pressure on the spending side of the budget. And we also have, significant commitments in school finance that, the governor-elect is going to have to confront that are built into current law. So, there's a lot of continued risk that we face. I can't see the situation, even if the economy starts to do better, going away. Now, we talk about a $9 to $10 billion problem in 11-12 because of a lot of the resource that goes away. that problem increases to $14 billion in the 12-13 budget and to $17 billion plus the year after that in our planning horizon. So there's no easy kind of future we're going to be facing here. Very, very difficult decisions are going to be made, have to be made. And quite honestly, we are in the position now where the state is going to have to decide that there are certain things it's not going to be able to do anymore the way it's been doing them in the past. The numbers just don't allow it. So, unfortunately, that's the environment we are in right now. So I'm going to stop talking and